tulemast Investor Toomase konverentsi viimasesse osa. Minu nimi on Alejandro. Ma elan siin Eestis ja ma tõesti armastan Eestis elada. On väga ilus koht. Täna me räägime investeerimisest, aga palun inglise keeles. So, I am not from Estonia. I know this probably shocks everybody here because of the perfect Estonian I just threw at you. So I'm learning it. I'm probably at the level where I speak like a 9-year-old, but I have 2 young children, so it's great because I get to practice with them every night over dinner time. The problem is my wife, who is Estonian, she constantly has to intervene with something like, you have to stop talking to the kids in Estonian. They're learning it wrong. The teachers are complaining. They're going to get kicked out of kindergarten. So, yes, she is right. So, I moved to Estonia in 2019. But why did I move here? So, yes, my wife is Estonian, but that's not the reason why we moved. We didn't have to move here. We were living in New York City before over here, and we were very happy as a family. I was very happy in my career. I was doing quite well. I was a partner at JP Morgan. I proudly and humbly say that JP Morgan, in my view, is the premier bank on Wall Street. Definitely the most valuable bank in the world, as per 400 billion in market capitalization. So things were going well. And my wife left Estonia in the early 2000s, which, as you know, was a very different Estonia than it is now. So there was really no rush to move back. But what happened? 10 years before moving here, when I met my wife, I realized how little I knew about Estonia. And there's a beautiful saying that the more you learn, the less you know. Well, that's how I felt about Estonia. So I started reading about your country. I started visiting, I started talking to people, and I became fascinated with the amount of progress that you've made since you regained your independence. This is a country that is moving forward, whereas many countries in the world are moving backward, and I've lived in many countries, I've seen it. The more I read about Estonia, I became fascinated with the digitalization of this country. It's amazing, all the services that you have online, from voting, taxes, healthcare system. You can start a company in minutes. That is so unique. Your children have the best test scores in the Western world as per PISA OECD exams. That's pretty impressive. Your cities are clean, they're safe, there's low corruption, you have the most efficient tax code in the world. Even public transport is free here. That's incredible. Universal health care. You found almost the most perfect balance of having a capitalistic democracy that has all the social safety nets to make people thrive. This is incredibly unique. So the reason I'm telling you this is, you know this, but wow, you should be proud of this country. You've done really well for yourselves. Let me tell you a story. When I was leaving New York in 2019, this isn't that long ago, it wasn't the Stone Age. So my daughter, she was born in a New York City hospital. So she had a New York City birth certificate from the hospital. And I wanted to get that birth certificate notarized globally so that when we moved here, it would be accepted anywhere in the world. To do this, ladies and gentlemen, I had to go not to 1, not to 2, not to 3, but to 4 government offices in New York City, not even in the same building. I had to wait in line, not online, in line, like a dummy, just, what time, this is, what a waste of a morning. The first office, their job, the clerk who I saw there, basically just signed off. His job was to sign off that the birth certificate that I had from the hospital was real, was authentic. Okay, he signs off, he gives me a piece of paper. Second government office, the guy's job was to sign saying that his colleague's signature was real and authentic. You can't make this thing up. And this is only government office too. For each of these offices, I had to pay $6 or $7. Some of the offices accepted credit cards, some just cash. But one of them, I don't know why, one of them accepted only checks. Ladies and gentlemen, you do not know what checks are because you bypassed that technology. This is New York City, the capital of capitalism, the center of global finance, where trillions of dollars move every day. I could only pay by check. My God. At that moment, I said, yeah, we made the right decision. We got to move to Estonia. This is a waste of time. So we move here. But then the next question is, what the heck am I going to do professionally here? So I had done my research. For many, many years, I had read about your awesome startup scene here. I was just enamored with what was going on and how such a small country could do so much. I read about Skype. I'm like, I've used Skype. I didn't know that was Estonian. In fact, my clients at JP Morgan invested in Skype because in the JP Morgan portfolios that we managed, we had a position in the Silver Lake private equity fund. And Silver Lake ended up buying a majority stake in Skype from eBay. So I thought, that's pretty cool. My clients are investors in a piece of Estonia. That's great. I read about another startup called TransferWise at the time. And by the way, this is all in mainstream media, CNBC, Bloomberg, The New Yorker, nothing that wild. And I loved what TransferWise was doing. Wow, they're revolutionizing the payment system. This has to change. And I read about Verif, Jobatical, so many cool startups. I said, I want to be part of that. I want to reinvent myself to be part of that world and join something that is very young and help it grow. So I moved here, I started investing in startups. I met many founders, I met many investors, investing as an angel. And a couple of years after I had arrived, I heard about a startup called Grundfin. And I loved what they were doing. It was very early stage, and they were helping people invest sustainably. And I thought, wow, the world needs a lot more of this. And, sustainable investing is in a very early stage, and so was the company. So I met the founders, one of whom is here, Trine Hertman. And I knew about Trine because she was the first employee at Wise here in Estonia. So Wise is a company that I really admired. So having the chance to work with the first employee here who helped build that business, well, that sounds like an awesome opportunity. How cool to work with somebody that has built the company from within. I met the other founders, Karin and Alvar. We hit it off, awesome people, love working with them. I helped them manage the portfolios. Let's rewind back to the early 2000s to tell you a little bit about my career at JP Morgan. So I joined JP in the summer of 2001 as an intern. I was a young puppy, excited in the big city, skyscrapers, New York Stock Exchange. Wow, all these bankers, they know so much. And by the time I left in 2019, almost 2 decades later, I was a partner and managed a big team of people where we had over $30 billion, 30 billion with a B in assets. And it was so cool because we got to invest across all global portfolios, all types of asset classes. I was in the asset and wealth management division. We invested in stocks, bonds, commodities, private equity, real estate, venture capital, all types of derivatives, call options, to very sexy ones like credit default swaps. But the cool thing is that I got to see so much because when I joined in 2001, the US was in the middle of a recession. We were in the middle of a bear market. The first internet 1.0 had just blown up. It was a very tough time. And a few months later, 9/11 happened. 2 airplanes crashed into the World Trade Center in New York City. Very difficult time. I was very happy that I was able to get a job in those conditions. Then came the bull market of the mid-2000s, followed by the Great Recession, the global financial crisis. Wow, that was scary. Then followed by the amazing bull market of the 2010s. Now, what's interesting is that 2022 was a very difficult year. When I started working in 2001, that was a very difficult time too, as I mentioned. So I would talk to the older bankers who had lived the bull markets of the 80s and 90s, and I would tell them, man, you're so lucky you got to invest in these bull markets. It must have been so easy. Younger people now come to me and say, wow, you were so lucky that you got to invest in the 2010s. What a bull market. It must have been so easy. And as I understand, most of you have, call it 3 to 5 years of investing experience, so it hasn't been the easiest period. Yeah, 2022, COVID. But indeed, it was a difficult year. But the answer that my older colleagues gave me is the same answer I give to the younger people today. Yes, they were awesome bull markets, but they were never easy. They were never easy because when you're in it, you don't know what's going to happen tomorrow. In hindsight, it's super easy to judge a bull market, but when you're living it, there's risks every day. The outlook is never clear. There is never a perfect time to begin investing. You just got to start. You just got to start at some point. So in a little bit, I'm going to take you back on a time machine, and we're going to relive the 2010s bull market the way I lived it. I think it'll be fun. But before that, we got to start with 2022. This is the main headline on the Financial Times, the last trading day of 2022. Stocks and bonds shed more than $30 trillion in brutal 2022. $30 trillion lost. Global GDP is $100 trillion. So almost a third of what's GDP got lost last year. Inflation, that's what caused it. Chart on the left, US, chart on the right, Europe. Inflation just moved so fast and so high relative to where it's been in decades. It caught central bankers completely by surprise. So what happens when inflation rises like that out of control? Central banks have to react. So on the chart on the left, you can see what the US, what Europe, what England did. They had to raise rates aggressively. So we went from rates that were 0 or even negative to all of a sudden in the US 4.5%. That's a shock. Add to it that trillions of dollars and euros are being taken away from the market right now through quantitative tightening. So what is that? Basically, after the 2008 crisis and after COVID, central banks began printing money like crazy, to get it in our pockets so we could spend, and that would help the economy. That would help risky assets. But eventually, that experiment needs to end. When there's too much money, inflation comes. So central banks are withdrawing all this money now to try to bring inflation down, and what happens? Interest rates go up. Because the cost of money goes up when there's less supply of it. So when interest rates go up, the bond market falls. So this is a very busy slide. But just look at the gray bars. This is the bond market going back almost 50 years. Almost never you lose money. Bond markets are supposed to be safe. But last year, not only did we lose money, but the losses were quite big compared to history. Pretty incredible year. Same chart but for stocks. When bonds fall, stocks tend to fall as well. Stocks go up most years. But last year was pretty bad too. Worst year we've had since 2008 in the stock market. 2022, it'll be hard to forget. So the reason I'm telling you all of this is to take you back in time to what it felt like to be in the 2010s, but you got to begin with the great financial crisis of 2008, when it was a very dark moment. The 2008 crisis originated in the United States mainly because of inflated real estate prices and all the lending that went against it. So when real estate prices began collapsing, banks began incurring billions and billions in losses. And suddenly, major American banks were going bankrupt. There's panic when banks start going bankrupt. You don't know if your money's safe. The banks are the oxygen of the economy. They provide life to other sectors through consumer loans, payroll loans, inventory loans. Build a new factory with this loan. So suddenly in the US, the banks are going bankrupt, but guess what? Other sectors are being affected too. Suddenly the automobile sector is on the brink of bankruptcy. The insurance sector suffered heavily. McDonald's was in trouble. The conglomerate General Electric that made refrigerators and wind turbines, they were in trouble too. And suddenly we began seeing on TV how UK banks were going under. I remember seeing a video of people just waiting in line in banks to withdraw their money. There was bank runs in Great Britain. We hadn't seen this in the developed world since the crisis of the 1930s, the Great Depression, 80 years, entire generations of people that had never lived anything like this. So it was very dark. Even banks in Iceland were going bankrupt. It's like, what the hell does real estate in Arizona have to do with banks in Iceland? It was all so connected. There was panic, and the stock market fell 57%. But then in March of 2009, the S&P 500 hits a very ominous level, 666. You can look this up. I swear to God, 666 is the level that the S&P 500 bottomed at, March of 2009. And then it started going up. It started going up. But things felt horrible back then. The economy was still in free fall. Your friends were still losing their jobs. Bankruptcies everywhere. Bad news all over the media. And then the 2010s start. And we have a lot of bad news starting in the 2010s. Dubai is on the brink of bankruptcy, one of the biggest potential defaults in history. There's turmoil in the Middle East with the Arab Spring. Governments across the Middle East being toppled. So the market is really concerned. What's going to happen to all the oil we need? The world depended so much on Middle Eastern oil. Still does, but there was a heavy concern about that. Terrorist groups were being formed in this chaos in the Middle East, in parts of Syria and Iraq. ISIS gained strength. And there was a terrorist attack in France, the worst attack on French soil since World War II. 100 people dead, 400 injured, bars, cafes, restaurants. We were questioning whether we had to change our way of life. Can we go outside to a restaurant? Can we go to a cafe? Is it safe? This was happening all over Europe. But the market kept going up. 2011, the United States government loses its perfect credit rating. It's AAA status, gone. If you can't trust the US government to pay you back, who can you trust? Panic in the markets. But then it kept going up. Then we had the euro crisis. That lasted a good 5 or 6 years. But there was a legitimate concern that the European Union was going to dissolve and disappear. You can't say this today, it's not politically correct, but back then you'd call them the pigs. Portugal, Italy, Greece, Spain. Fiscally, they were unsound. Germany's going to kick them out, or they're going to leave, and the euro will disappear. Ladies and gentlemen, we had meetings about what's going to happen to our euro positions. Are we going to get paid back in Deutschmarks? Maybe Italian lira, Spanish pesetas, all the currencies before the euro. This was a legitimate concern, but the market kept going up. Brexit, 2016, an actual member of the EU leaves. The market keeps going up. November 2016, Hillary Clinton will win the US election, said all the experts. Trump wins. Market sells off by 5% overnight. Then it keeps going up. And this was the 2010s. You had natural disasters, you had Ebola scares, you had trade wars with China, but the market went up 400%. Even under all this uncertainty, all this risk. I had clients, very smart clients, by the way, who sold in 2011. They said the market can't go up anymore. It's impossible. It's going to collapse. They missed the last 9 years of a bull market. trying to figure out when the market hits bottom, trying to find the perfect time to invest, trying to invest when everything looks good. It doesn't happen. You just got to start. If you haven't started investing, just start. Just start. Every month, save a portion of your paycheck and just invest. Invest. Doesn't matter where the market is. Just invest. Just invest. Just invest. Because you're never going to get the timing. The reason I feel comfortable recommending just to invest is because this is the oldest of the famous indices, stock indices. The Dow Jones Industrial Average, created by a guy named Dow and a guy named Jones. 7% up a year for the last over 120 years. This goes back to 1900. 7% a year, period of military conflicts, high inflation, economic depressions, you name it. 7% a year. And the reason markets go up over time is because the economy grows over time. Expansions triumph over recessions. For the last 100 years, your average expansion has lasted 47 months versus 14 for a recession. Bull markets win because of this. Trying to time the market. I couldn't believe this the first time I read it. I had to calculate the numbers myself. Had you invested 20 years ago in the US stock market, invested, went to sleep for 20 years, woke up, you had a return of close to 10% a year. Fabulous return. You just invested, buy and hold. However, had you started 20 years ago and you tried to time the market, and you missed the 30 best days in that entire 20-year period, not 30 days in a year, 30 days over the entire 20 years, your return goes almost down to zero. 30 days trying to figure out which of those are the 30 days, that's a hard task. And I know it's hard because 90% of US and European fund managers have underperformed the stock index. 15 and 10-year period. 90%. If you go back further, it gets even worse. 90%. Timing the market is hard. The world is made of 8 billion people. Trying to figure out how these people are going to behave rationally in their consumption, in their companies. Trying to figure out how companies are going to act, how central banks are going to act, how trillions of money is going to move and flows is very hard. That's why they underperform. But you got to start. You got to start investing. Got to start investing. And when you start investing, think long and hard about what's your risk tolerance. How much can you tolerate losing in a year? Are your return expectations realistic? Can you invest over a long-term horizon, or are you going to invest short-term and be forced to sell at a bad time? Think about how much debt you have. And maybe if you don't have debt, maybe you can add a little debt and juice up returns. Why not? Taxes, and finally, values. I think this is the next big one where a lot of more people are focused on investing in their values. And I am forbidden from doing a Grunfin sales pitch here. Don't you worry, I won't do that. I do want to be invited back here. But if sustainable investing is something that is dear to you, on the climate side, there's some really cool ETFs. So basically the Paris Agreement is this momentous agreement where nearly 200 countries came together and agreed that global warming is a problem, and the way to solve it is to get emissions down to zero by the middle of this century. So there's companies that are beginning to align themselves with these goals, and there's Paris-aligned benchmarks that follow, basically, indices of companies that are aligned to this. And by the European Commission standards, these ETFs need to have 50% less carbon emissions than the overall stock market and reduce those emissions by 7% every year. So that's pretty cool. And lastly, to close, this is more for the younger people in the room. So, you know, I don't like having a template to say, this is what you have to do to be successful professionally or anything like that. Like, you know, these are the 7 habits of highly efficient people. Why 7? But I think everyone's different. Everybody's circumstances are different. You need to make difficult choices sometimes that other people don't have to. But if I may share some thoughts of things that have worked for me, first and foremost, be curious, be open-minded, meet new people. You never know what doors will be open. You never know what new passions you will discover. I'd certainly never expected to be in Estonia, and I'm loving it. Take risks, but be thoughtful. Probably we were too thoughtful in coming to Estonia. 10 years is a long time. Don't do that either. Surround yourself by people that you can learn from, especially at work. If you're there interacting with those people a lot, you know, it's worth having somebody that inspires you. And certainly pessimists don't inspire. My view, we'll leave it at that. Start investing at a young age. Save a portion of your paycheck every month and invest some of that, and keep investing, keep investing, keep investing. In the long run, you're going to be happy. For those of you who are in the financial industry, the CFA program is one of the best things I've done. If you really want expertise in your field, the CFA program is a really good way to go. And lastly, I had the fortune of playing with retirement after I left JP Morgan and before I joined Grundfin. And really, it's not that great. It's not, yeah, the ride is much more fun than the destination. And you kind of feel empty if you don't have anything going for you, any ambitious things like that. So retirement is overrated. That's it for me. Thank you. Aita.
Great. This applause says that we have to repeat now. But thank you very much, Alejandro. We have some questions in workshop. So first question. Economic growth has been linked to the global population growth, and some assume that soon the global population would start declining. What would happen on the markets?
Yeah, well, I mean, we're far away from population growth declining. I'm glad that question was asked, because I was talking to my fantastic colleague Mart, who's here as well, and he was showing me some analysis that actual population is expected to peak at 10 billion people. We're currently at 8 right now. 10 billion, I think it's closer towards the end of the century. So we're still quite far away from that. And really, I don't think it'll impact markets that much, assuming it were happening today, because the productivity of the companies is constantly increasing. And sort of kind of like a sad thing that you see after every major crisis, companies have massive layoffs. This is what happened in 2008. Massive layoffs. And then even when the economy begins growing, the companies just don't hire back. They use the crisis as an opportunity to cut down some of the fat, become slimmer, and increase their profits. So ironically, sometimes it works in favor of the stock market, having fewer people becoming more productive. But I think we're far away from that problem.
There's a practical question, and let it be the last one. I will let you answer it. What is a CFA program? Someone is asking.
So the CFA program is the Chartered Financial Analyst program. It's a global program where an institution called the CFA Institute, they force you to pass 3 exams that look at everything in finance, from economics, statistics, portfolio management, company valuations, stock market technical analysis, all of that. And you got to pass the 3 exams to get certified, but just the studying for the exams are very difficult. It usually takes about 3 years to complete it. That's why I recommend it more for people in the financial industry. But once you get that title, at least New York, London, Hong Kong, it is a very prestigious title because it shows the effort and the knowledge that's behind it. So I highly recommend it for anybody in the financial industry.
Thank you very much, Alejandro.
Alejandro.